All right, how's it going, friends and family? My name is Amos. Welcome back to another episode of the Compounder's Corner. Today, we're going to be taking a look at the companies reporting their earnings this week, and I'll be sharing my commentary on which ones have my attention and which ones I'm bearish on. And on a high level, here are the biggest takeaways from this week's earnings. Number one, it's a continuation of the AI infrastructure players such as SMCI on Tuesday, Applied Materials on Thursday. We also have Cisco on Wednesday, which, as of recently as a whole, they sold off because news came out that China is developing their own stuff and everyone is just being catastrophically thinking that it's the end of American and European AI infrastructure names. Well, turns out that dip was a buying opportunity because they've all pretty much recovered. So if you bought the dip, congratulations. This upcoming week, we also have restaurant names such as Cava, Brinker International, which is the parent company of Chili's and Maggiano's, Noodles and Company, and of course, Red Robin. Does anyone even eat at Red Robin's anymore? Anyways, number three, we also have the inflation data reports on Wednesday and on Thursday, which, as we all know, the Middle East situation has made oil prices absolutely stupid. So I'm not going to be surprised if inflation is higher than expected. And to be real with you, amigo to amigo, I woke up today and I said to myself, I really don't feel like doing anything. So the agenda is to just waste the day and feel sorry for myself. But between you and me, I know that's the stupidest thing I can do. Because when I feel that way, taking action, doing stuff, even if I have to force it, that's what turns the tide. So getting to work on a passion project like what you're listening to or watching right now, Compounder's Corner, it gets my heart pumping and it reminds me why I love doing it in the first place. And it's for the best that I get out of my own head and to analyze the markets instead, right? And also, I don't want to be cheesy here, but I read your comments on my last video, this one right here, and the encouraging words from the community from you, dude, it meant a lot to me. Reading what you guys posted completely shut down the lie in my head that nobody cares, and that my work is meaningless, and that my existence, it doesn't matter. Like if I were to be gone tomorrow, it wouldn't matter. Terrible stuff, right? As stupid as it sounds, knowing that even one person appreciates you being around, it gives you a reason to keep pushing. And in this case, it looks like about 50 to 100 of you. So I have to stop with that type of thinking and mentality. Now, before we hop into each day of the week on a deeper level, let's do a very quick recap of how things went last week. I think the biggest headline last week, Palantir, they absolutely crushed expectations, and their commercial business is growing at a faster pace than anyone expected. Yes, I regret not buying them prior to their earnings because if we just go back past 5 days, you could see they went up 40% into the green. Prior to their earnings, roughly 120 some dollars a share. That was almost easy money, right? If we pull up, is it under metrics, government? Yeah, so if we break it down, trailing 12 months, quarterly, no, I think it might be better to go to financials tab, click on KPIs, and will it show us the growth? Yeah, government growth year over year, 75%. Commercial growth. So when you think about the S&P 500 companies utilizing Palantir software, 137% growth year over year. So if you take a look at what has been happening since fiscal year 2023, it is just a magnitude of growth year over year for the past 3 years. And so when we talk about vibe coding, Anthropic's Claude, and everything is going to make software obsolete, I hope that narrative is finally laid to rest because software companies are thriving. And also last week we had Uber, and they got punished pretty harshly right after they reported. They went from $72 a share down to roughly 65, if I can get the low right there. I guess 65.41. And then by the end of the week, I guess this past Friday, they rebounded. So I think if you bought the dip on them, you'd be a happy camper, right? 6.5% in the green. As of right now, maybe this is something that I'll regret, but personally, I think Uber is one of the most undervalued companies in the market right now, especially for the numbers that they're executing and the scale of their operation. It's just phenomenal. And so when the market punished them, I'm not even joking. I almost jumped in. I hesitated, uh, but I'll live with it, right? Because I think my personal buy price was under like $61, $62, and it wouldn't have happened anyways. So if you're an investor of Uber, I think there's a lot to be excited about because I think they're doubling down and investing a lot more money into their AV capabilities and platform, especially partnering with those that are manufacturing the AVs. And if you take a look at their free cash flow, I think they had a record amount. Hold on, let's see. Cash flow, S&P Global, okay. Investing opportunities, net cash flow, free cash flow right there. Yeah, so for the trailing 12 months, they have $10.1 billion of free cash flow. So if you take a look at oh my gosh, what is happening right here? If you take a look at it historically, it's the best they have ever posted. If we break that down on a per share basis, $4.84 of free cash flow. Oh my goodness, that is insane. So Uber, I really like, kind of regret not jumping in, but it's okay. And then also last week we had Celsius, ticker symbol CELH. Pull them up right here. The energy drink operation, very similar to Monster, except Celsius focuses on the healthier ingredients. They reported their earnings. Take a look at this. And afterwards, they dropped like a rock. I think they went down 20%. And between you and me, I didn't think the numbers were so bad. So case in point, by Friday, they had a rebound of 16%. I think the market overreacted, and that's why we do this, right? That's why we pay attention to companies reporting their earnings, because when the market wants to behave like an irrational monster throwing a tantrum and they sell you off 20%, buy the dip, you sell the rebound, 24 hours later, bam, 16% profits secured. Or if you're a long-term investor, bam, your cost basis is now $23.50. Happy camper. Like if you believe in the long-term, the longevity of Celsius. Although one thing that was of concern to me is if you take a look at, break this down on a quarterly basis, their revenue only grew by 10% year over year. So for me, I think that's a yellow flag because it shows you their momentum is slowing down, despite them spending a crap ton of money to buy out, I think it was two different energy drink brands. One is Alana New, and the other one is Rockstar. Despite buying that out, you would think the inorganic growth machine would keep going, but to go from 172% growth, 137% growth in their top line down to only 10% growth, for me, I think that's a yellow flag that's valid. So I think I can see why the market punished them that harshly, but to see a rebound of 16.8% almost the following day, I also feel like that's irrational. So both ways, I feel like the optimism surrounding Celsius, but also the critics, y'all are just way too polarized. I'm somewhere in the middle. I think Celsius, based on their numbers, they're okay. I'm not going to say that they're the greatest opportunity in the market. Like, I would say Uber is a better opportunity. I would go as far as to say Palantir, prior to their earnings at about 124 a share, was a better opportunity than Celsius. But Celsius, it's not the worst idea. Like, if you're invested in them, I wholeheartedly understand why. Because almost every single metric and fundamental across the board is looking pretty phenomenal. Just for me, I just don't know about how durable and robust their economic moat is truly going to be. And I don't want to play into that fear of Costco releasing copycat private label energy drinks saying, oh, it's the end of Celsius. I think there's room for both of them to thrive and to grow because if you pull up their biggest competitor, or I guess the biggest dog in this fight, Monster, you would think they would be dead because of the private label brands, but I mean, contrary to that, they're 86% in the green for the past 5 years. And so, why can't Celsius also be thriving, right? So, for me, I'm cautious and I'll be rooting for you guys on the sidelines. It's just not a position that I personally would want to jump in. So, with the recap out of the way, let's go ahead and take a look at August the 10th. On Monday, there's 202 different publicly traded companies reporting. The biggest dog in this day is going to be Simon Property Group. It's a REIT that specializes in shopping malls. We have Ferguson, an HVAC company based out of Virginia. We have Aon, an American-based HVAC manufacturer. Hims and Hers Health. By the way, how have they been doing? This is a company that we did a deep dive on the channel, I want to say like 7 or 8 months ago. Let's see, past 1 year, negative 38%, year to date, negative 2%, past 3 months, 17%. So it looks like it's been pretty volatile. But for the better part of 6 months, 37% in the green. So pretty good. And then let's see. Let's go ahead and talk about this one. Ticker symbol USAR. It's one that I'm really interested in, and it's USA Rare Earth. So it's a rare earth elements mining company that's tiny in scale in comparison to MP Materials. But I still think they're undervalued by a significant amount. Now, this is also, just like Hims and Hers Health, very volatile. Year to date, 62% in the green. We do past 1 month, pretty much flat. Past 5 days, 30% in the green, past 5 days. So it's one of those positions that is not a sleep well at night. You got to have the stomach to be able to handle the roller coaster ride of the ups and downs. Take a look at this. They used to be a pre-revenue company up until 2025 when they bought out some companies that are doing mining around the world that diversified their operations. But for the most part, I think their bread and butter going forward is going to be a very important location in the US known as the Round Top Mountain near Texas. So if you're bullish on EVs, drones, satellites, missiles, and everything else, the main component, the ingredients to make that stuff, rare earth elements. And for the most part, I think like 94, 93% of all rare earth elements right now are sourced in China. And so I think America, they're trying to diversify and prioritize making that stuff in-house. So if you believe in that vision, USA Rare Earth. So if we go on back to the overview of Monday, then again, there's a lot of ups and downs, so it's not a sleep well at night type of investment. Got Monday.com. This is one of the software stocks that I did not believe in. Like if we were going to talk about software enterprises that were going to be obsolete because of vibe coding, I thought of Monday.com. But I want to see if they were resilient, and it looks like they have been. Because after their initial big drop from about 150 down to, what's that low? $57.50. If you bought the dip and we say, I don't know, past 3 months, 25% in the green. So even a company that I labeled as tier 4, very questionable future, even they eventually recovered. So if you're invested in Monday.com, congratulations, and I'm truly happy for you. And as we keep moving on down this list, let's see if there's one that catches my eye. Oh, there's Dole, ticker symbol DOLE, and they're in the business of selling fresh fruits and vegetables. And I'm not really interested in Dole, but I do want to mention this, okay? So about 2 days ago, I put the 2 and 2 together. You know how lately we've been seeing a lot of foodborne illness outbreaks happening, especially here in the US, revolving around the lettuce, cilantro, jalapenos, and everything else, right? Taco Bell had the cyclospora, Chipotle and Cava had the salmonella, and everything's happening all at once. And then it's also been publicly disclosed about a week ago that a bunch of water treatment facilities have been breached and hacked into by outside forces. Folks that may or may not be related to the conflict in the Middle East. Now, before I get carried away, here's my little disclaimer. You might want to whip out your tinfoil hat. What if they're messing with our water supply on farms, and as a direct result, it's giving us but COVID? When you think about it, diarrhea warfare. They're trying to hit us where it hurts. Because you can't really fight the US or the American military head on, right? The capabilities, the manpower, the equipment, it's overwhelming. So they're trying to hit us where we are vulnerable. So my whole thing is, if this is true, and it's the folks in the Middle East, I think, or even if it's not, right? I think the cybersecurity stocks are going to be the biggest winners going forward, because as a society, we are finding out how valuable a good defense system is to protect your data and your company. Unfortunately, nearly all of the cybersecurity stocks have rebounded to new all-time highs. And I say that because every quarter, like one or two S&P 500 companies, their data will be breached, and hackers will literally say, give us $5 million or we're going to mess with all of your systems and release your sensitive information. And you would think the companies would hold out or say no, but most of them end up paying the hackers the money. And if you don't believe me, pause this video and look it up. Every single quarter, some of the biggest blue chip household name operations, they get hacked and they pay a ransom. It's pretty wild. It's something that you would only expect in a Netflix or a Hollywood movie. So if you go to Hack, which is an ETF that holds some of the biggest cybersecurity names, almost every single one of them are at their 1 year high. Don't believe me? Let's go to Palo Alto, click 1 year, 110% in the green. They went on a sell-off with the rest of, I guess, software-based names, and they reached the low of about 139. So if you bought the low, simplicity's sake, 6 months back, 128% in the green. So that's the biggest dog by market cap. Another really big one would be CrowdStrike. Do 6 months for them, 116% in the green. Do you guys remember I uploaded a video talking about how I was going to investigate and research which cybersecurity company to invest in because the sell-off was unwarranted in my pea-sized brain? And eventually I came to the conclusion of my exposure in Microsoft was enough for cybersecurity. Dude, I wish I would have invested in freaking CrowdStrike or Palo Alto, right? Hindsight is 2020. I mean, I'm not disappointed. I loved the fact that I love the fact that I invested in Microsoft when I did. It's just, I wish I would have diversified at least like $5,000 into this ETF, right? 6 months, 53% in the green. Personally, I don't really like going to ETFs. I like picking the biggest winners within the ETF. So in that case, it would have been Palo Alto or CrowdStrike. I would have been a happier camper. But that's greed talking. Because even with my Microsoft position, it paid off, right? Buying the dip to 350, and now they're flirting with 500. Everything worked out in the end. It's just greed talking. So that's just what I think. And then another one that I want to address is Webtoon Entertainment. I'm sure none of you have heard of this. Ticker symbol WBTN. It's a Korean comic publisher. So think about Japanese manga, but in full color. If you take a look at their stock market history, debuted, what is this, 2024, so roughly 2 years ago at $22. Now they're $8, negative 61%. And if you take a look at their numbers, it kind of makes sense. Like when you IPO, you would expect the growth to be around there, right? A teenage growth number of 18, 15, 16% year over year. But to see it fall in the exact opposite trend, I mean, that's just going off the top line, right? Like that's not good. It is slowing down aggressively. Like somebody is slamming the brakes. And the fact that the profitability is getting worse and worse, they're burning cash to keep the lights on. Just those two metrics alone tells me that I don't even need to bother looking at the balance sheet or the free cash flow to know that the fundamentals are probably looking pretty rough. And to make matters worse, you would think that because of the sell-off, maybe they're undervalued. No, because their forward PE is a 80, a fat freaking 80 for a company that's unprofitable, for a company where the revenue is only growing by 2%. Now, the reason why I'm talking about this so much is I actually had a really close buddy of mine that put, I want to say like 50 or 60% of his entire net worth into Webtoon. He was super bullish about Webtoon back when it was still private, back before it IPO'd. I think this was like in 2017, 2018. And doing my homework and research for this podcast made me think about him. I genuinely hope his investment is doing well. Like perhaps when he put his money into Webtoon on the private side of the house, maybe it was $1 a share. Now it's $8. So hopefully he's in the green 900%. But yeah, if I had to invest in a tiny studio producing entertainment or content, believe it or not, I'd rather go with Angel Studios. It's a company that I covered on the channel, I want to say about a month or two ago at the end of the episode. And that's why you got to watch or listen to the very end. So I throw down these nuggets at the most random parts of the video. It's never front loaded. I try to spread it across some good stuff in the beginning, good stuff in the middle, and the juicy stuff at the end. So if you do watch this stuff and you're impatient, I would skip everything and always just go to the end. Because I feel like that's when I usually say the most. The epiphany will occur towards the last like 5 or 10 minutes. But anyways, Angel Studios, their business model is really interesting because they have a membership platform. They have millions of people, okay? Where people pay into, and then Angel Studios will use that funding to make movies and TV shows. Does that make sense? So instead of them taking out a crap ton of loans, I mean, they do take out loans, and we can see the evidence of that on their balance sheet. The liability side of the house, you take a look at total, hold on, let's pop this over from S&P Global to Fiscal AI. Total debt, $77 million of debt. I mean, that's nothing, right? Most companies have $77 billion of debt. So they still do have debt, but they primarily use the membership subscription fees from the members to make the content. And sometimes they even do direct crowdfunding to produce content, such as The Chosen. It's a pretty good series if you've never watched it. So why am I talking about them? If you pull on up their P&L, which is the income statement, take a look at this data source. Let's go to S&P Global. Okay. Their revenue is growing at a rate of 230% for fiscal year 2025. And then in the trailing 12 months, 121%. Break it down on a quarterly basis. It does look like things are slowing down. So if in this next upcoming earnings, I don't know when it's going to be. Because it was June 30th, I'm assuming they reported in the middle of July, maybe at the end of July. So in their next earnings, if that number goes down again, then everything that I'm about to say goes right out the window. But if it does go right back up to a 400 or 200%, then everything that I'm saying, that's the information that I'm using, predicated upon. So obviously that's a big what if. So Angel Studios, I'm really bullish on because I think right now, it's still pretty early. Now, obviously, if you bought into them when they were still a SPAC at $10, you would be pretty pissed off because your position would be at the beginning of the year, they were roughly, what, $12? Your position would roughly be in the red 60%. Not a happy camper. But to buy them right now at roughly, I guess in April, they were $2.04. Your investment in them, you'd be a happy camper, right? Even just in the past 3 months, 41% in the green. I would rather go with Angel Studios than Warner Bros. Discovery. So if you take a look at their gross sales, I mean, it's just slowing down, right? And a lot of that is attributed towards divestitures of them getting rid of some franchises or some studios or intellectual property that were in their portfolio. And that's why it's decreasing. But still, it's decreasing nonetheless, right? You want to see a company be growing. And that can be measured in many different ways, right? Market cap, their stock price, but also the number of shares outstanding, or gross sales, or through their free cash flow, or their dividend profile. Warner Bros., there's nothing about them that gives me a fuzzy feeling in my fat sack of a beer belly that I've got going on, right? And another one, Paramount. No, I would rather go with Angel Studios because it's almost the exact same situation as Warner Bros. I mean, for the past 3 years, it's pretty, I mean, for the past 5 years, I mean, for the past 10 years, it's pretty much flat. It's not exactly what you want to see, right? I think I'm really sorry if you're invested in Paramount or Warner Bros. Maybe I'm being a little too harsh, but I think they're both value traps as it stands right now. Now, maybe when the merger goes through and they connect everything and they start pumping out content that's amazing, box office hits, I'll eat my shorts. Maybe they'll skyrocket 400% in the green. I genuinely hope so. But me personally, I look at the data, I look at the numbers, and there's nothing compelling that says, like, I need to own them. Now, for Angel Studios, yes, the steam is letting off a little, but you lift open the hood, and you look at the engine, and I think there's a lot of potential there. I'm not going to say it's a good bargain because they're unprofitable. I'm not going to say they're the best deal in the market. But if high risk was the name of the game, Angel Studios. I do not have skin in the game. If you're thinking, oh, maybe that's why you're buttering it up so much. No, I really don't. It's just, I say it as I see it. I think the numbers paint a story that's convincing, but I think I would hesitate jumping in. I think the only way that I would jump in is if there was absolutely no more deals on the market and Angel Studios was the only one that looked like a bargain. And as of right now, I disagree with what I just said. I think there's still a lot of good opportunities. I think almost everything has self-corrected and has rebounded, but there are still a few industries that are undervalued. So I would look towards that direction than Angel Studios. But I would still put Angel Studios on my watch list because I think at the right price and at the right time, especially for like, what, $2 a share? I mean, I know that's not a good gauge of valuation, but literally for $10 to buy 5 shares with the promise or up the upside of them hitting like $5 a share in the future or $6, I mean, it's not the worst thing in the world, right? It's just like fun money. Because I prefer to evaluate a company based on their PEG ratio or their PE or based on the historical dividend growth rate and stuff like that. But to just look at a stock price to say it's cheap or expensive, I don't think that's an accurate way. So for me, what I just said is only because of how many shares you can acquire for the price, if that makes sense. And then on Tuesday, 177 companies, we have C Limited, ticker symbol SE. The expectations are, I want to say it's modest for a growth company, 35% increase in the gross sales. It's basically the Singaporean Amazon. And 30% growth in their bottom line per share. We've got the Super Micro computer. They basically make the server racks for the data centers. That right there, my gosh, that's scary. The fact that they have to grow their revenue by 103%, and it's not even that. This stock market, I don't know if you guys been paying attention, it's not enough just to meet the expectation of 103%. You got to blow them out of the water. This pertains to the folks that are operating in the AI bubble. You can't hit 103, so for SMCI, they have to hit 130. I'm telling you right now, if they do not hit 125 or 130% growth in their revenue, they will sell off back down to $22, $21 a share. But based on what I've been seeing for the past few weeks of all the other AI infrastructure names, I think they're going to be okay. I mean, it's kind of confusing because the other day, AMD reported lights out earnings, right? Take a look at this. P&L quarterly. So quarterly means for the past 90 days. So their revenue went up by 50%. So if you just take a look at the past handful of quarters, it's the best that they have ever executed, right? So you would think the market and Wall Street and retail investors and everyone else would reward them. No. After they reported their earnings, they sold off. So I'm like, dude, I don't know what's going on. Maybe the expectations were already priced in, right? And they're just taking profits. That's my assumption. But AMD, beautiful earnings. So the AI bubble continues. SMCI, but it's one that I personally wouldn't want to because they have a history of fraud, cooking the books, and one of their high-ranking employees, I think a vice president or something, he was smuggling NVIDIA chips to China. There's a lot of scandals surrounding them. So if you're really bullish on server racks, I feel like the better name would be Dell because they don't have as many controversies surrounding them, right? Supermicro, high risk, high reward, whatever. There's Airmark. They pretty much supply the food and supplies for most college campuses, but also prison systems. We have On. They produce those shoes that are actually falling out of favor right now. That's what I keep saying, right? When it comes to like shoes, it's really hard to invest in because you just don't know what the consumer trends are going to be next week, let alone next year. So if you buy into a clothing retailer, you got to know when to jump ship and you got to be smart with it. This includes VFC, the parent company of North Face, Columbia Sportswear, Nike, Decker brands, on. Like, I would never buy and hold. You really got to know, like, when the curtains are closed and they're no longer relevant with Instagram influencers showing half their cleavage for the screen, even though it's a video about shoes. Like, why are you showing me all of that? Like, cover that up, please. You got to know when to jump ship with your profits. So as weird as it is, I feel like clothing, shoes, and retailers in that category, I feel like it's cyclical to a degree. Because, let me pull this up. One that fell out of favor with the consumers and then made a comeback that even surprised me is Abercrombie. Because when I was in middle school, high school, everybody wore polos, right? We popped the collars and we were stupid like that. But if you take a look at their stock, look at that. Highs and lows, it really depends. And then the past like 3 years, they had a renaissance and they had a comeback. And Gen Z, they think Abercrombie is so amazing. And I'm like, I'm so confused because when I went to college, Abercrombie, Hollister, American Eagle, they all fell out of favor. Like nobody was wearing them anymore. I think at the time, 2010, I think Polo, Ralph Lauren, that became the new Abercrombie. So with clothing retailers, I mean, as a swing trade, not the worst idea, but very recently I got burned severely because of a swing trade, and so I'm trying not to do those anymore, right? I'm trying to, listen, my whole goal is to maximize and optimize the growth of my portfolio with whatever means necessary, right? So taking stupid risks like that, it's counterintuitive to my goal. In simple terms, I'm trying to reach a CAGR of 25% year over year. Obviously, if I'm delusional and a little optimistic, we can push it up to 29, 30%. But if I do swing trades on something that's really risky, that's going to affect the numbers, right? So I personally would not want to. And now let's talk about Wednesday. We got 241 companies. There's Cisco. There is, by the way, Cisco is a really interesting one because at the dot-com bubble crash, they were the most expensive company in the world. So you can think of them as the NVIDIA back in 1989, 2000, 2001. And if you bought them at their right there, if you bought them at their highest point, March of 2000, it would have taken you 26 years to break even. 26 years. And that's why when we talk about buy and hold, I'm like, bro, when you think about the opportunity cost, sometimes you got to know when to just cut your losses and reinvest that capital. Because instead of waiting 26 years to break even and then to go into the green, excuse me, let me just drink some water. If you would have sold at a loss, did some tax write-offs, because it carries over year, at least it does here in the US. You can carry over at least $3,000 of losses per year to deduct against your capital gains, which I feel like that has not kept up with the rate of inflation. I read an article, I think like 2 years ago, I think it should be closer to like 29 grand. $3,000 of losses to carry over. Bro, that's stupid. They need to readjust that number. Call your congressman, call your local politician that's corrupt, let them know, air out your grievances, say why the heck is the carryover for your losses only $3,000 per year? Like, that makes no sense. But anyways, sell at a loss, take whatever capital's left over, and if me personally, I probably would have put it into like an S&P 500 or even like Procter & Gamble or like a consumer defensive growth, like a trash waste management type of company. And I feel like your ROI would have been a lot better than just to buy, hold, do nothing, and wait 26 years. I think the dividend would have made a difference, but I don't think it would have changed the game. So that's why I always say it's not enough just to buy into a company. You need to buy into it at the right price. Because even a really good company can be a really bad investment if you overpay for it. If you buy a company with a margin of safety baked in, do you know what I mean when I say that? A margin of safety essentially is this, okay? Let's say that you're eyeballing a company. That's all you think about when you poop, when you're at work, and you're in a freaking, the third meeting of the day, your eyes are glazed, you're like, what the hell are they talking about? And all you can think about is this stock. And you have their inherent worth at $100. They're currently trading for $50. What's the margin of safety? That upside to their inherent worth is $50. So to buy them at $50 is a really good cushion, right? It's asymmetric. The upside is a lot higher than the potential downside, as long as all things remain the same and they crush. Why would you be eyeballing a company when the margins are decreasing, when the gross sales are declining? Obviously, then you shouldn't be eyeballing them. Or any sane person shouldn't be. So that's my whole thing. To buy a company, like that company, inherent worth at $100, and to buy into them when they're 120 because you're saying, oh, I love them, you have zero protection anymore. The downside is unlimited. They could drop all the way down to that hypothetical 50. That's why even good investments, good companies can be bad investments if you overpay for them. But if you buy them with a 20, 30, 40% upside baked in, then you're talking about value investing. To me, it makes all the sense in the world. Some people would fundamentally disagree with me. They don't care. But it also makes sense, the other side of the argument, because it doesn't matter. Who cares if you pay $120 today? Because if you're going to hold on to them for the next 30 years and they're going to be $500 eventually, to get them at $120, it's a bargain. I get all of that. But what did I say earlier? The name of the game for me is to maximize my CAGR. So the cost basis for my positions, it really matters. For me to buy them at $50 versus $120 makes all the difference in the world, because that CAGR will be reflected of that. Anyways, I'm preaching to the choir. At this point, you're probably like, dude, shut up. You're yapping. I get it. It's what I've been doing. There's also Performance Food Group. They're kind of similar to Airmark. So I'm assuming that Cisco is also going to be reporting. Not this one, but the SYSCO. They're basically in the game of providing the raw ingredients like oil, the cooking oil, flour, sugar, meats, and everything else that a restaurant needs to operate. And it looks like for the past 5 years, 159% in the green. That's what I'm saying. Money can be made anywhere. If you're infatuated with only one industry, or you're chasing FOMO into Micron or SanDisk, dude, I would pump the brakes and literally just listen to what I said. Or I guess repeat it. Money can be made in almost every industry or sector depending on the time and the variables. Like, who would have thought that a food distributor supplying kitchens, 159% in the green, right? So it just goes to show, if you put in the legwork and a little bit of homework and due diligence, you can make money. That's not financial advice. I'm just living testimony of that. I don't just invest in tech. I don't just invest in Mag 7. Dude, I've made a killing. I've made so much profits from health insurance, from the military stocks, from you name it. Like, I'm all over the place. Most recently, Abbott, right? The medical device player. If you do your homework and research, you can make money. And that's not financial advice. I'm talking to myself. I'm schizophrenic. I'm delusional here. And then we also have Brinker International. This one right here, they're falling out of favor with the consumers. How do I know this? I am a huge fast food kind of guy, which is ironic because I have a six-pack. I work out almost every day. I haven't been lately, but usually I do, okay? So I keep up with the news surrounding restaurants and fast food. Come to find out, there's this big movement going around where, oh my gosh, everything that I just said went out the window, considering in the past 1 month, 27% in the green. But that's because everybody in the food space has been experiencing that. Because even if you take a look at Texas Roadhouse, past 1 month, 11%, even Cracker Barrel, like everybody, okay? It's not just, why aren't they pulling up? It's not just Chili's that's experiencing that. But anyways, the consumers are now understanding there's a difference between pre-made. Now, this only pertains to restaurants where you sit down and you get served. If you get served, the expectation is a what? 15, 18, 25% tip. Places where you sit down and eat and tip. There's a difference between scratch kitchens where they make everything in-house from A to Z versus stuff that's pre-made, frozen in a bag, and they just microwave it and give it to you. Now, it's come to the attention of the consumers that that's what Chili's is. Almost everything on their menu, except for the tortilla chips, maybe it is, I don't know. Everything on the menu is basically frozen and they just defrost it and heat it up in the oven, usually supplied by who? Cisco or Performance Food Group. Kind of funny, right? And so consumers are now saying, hey, I would rather prefer to go to a place like Chipotle, Texas Roadhouse, or Cheesecake Factory where everything is made from scratch in-house. But the food integrity, it doesn't really matter because everything that's made in-house, fresh, you could still get food poisoning. But I guess it makes sense, right? Why pay sit-down restaurant prices if you could just get a frozen meal from Walmart? You could just do it yourself. Why go to Chili's and do all of that? So me personally, I don't really care. I just sit down and eat. Like if I'm craving it, I'll go there. McDonald's, Five Guys, it doesn't really matter. But I know that's a consumer trend to be wary of. I think we're finally understanding there's a huge difference between the two. And I think this one right here is a military industrial player based in Europe. I'm not really sure. Let me see this. CAE? Yes, correct. They operate all over the world, mostly in the UK, Europe, Asia, defense. But where's their headquarters? Because I feel like it's Germany or France. Could be wrong. Canada. Okay. So North American based, but definitely in the military space. And then, do we have anything else that catches the attention of this individual with ADHD? By the way, I've been thinking about it. I wonder if it's worth it to get medicated. Because I heard that once you get on the proper treatment plan for ADHD, instead of having your mind fly all over the place, you're able to just be calm and think and be still. And to be honest, I can't really do that unless I do meditation, I do deep breathing, and I just practice mindfulness. And even then, it only lasts like 10 minutes. So I almost wonder if it's something that I should seek out. Then again, ADHD, I always say it's kind of like a superpower as well, because it gives me the ability to just think fast and be quick, especially with my logic. And but other times I feel bad because I might come across as rude. Because I'm always, it's hard for me to pay attention to what the guy in front of me is saying. So it's not my intention to be rude. It's just the way that my brain is set up. It's just an unfortunate thing. But anyways, on Thursday we have new, which is basically the Latin American SoFi. All else being equal, right now the valuation with new holdings and SoFi, it's pretty much the same. So I'd rather go with SoFi. And I think the valuation and the price might be the same as well. So 1384, SoFi, no, never mind. SoFi is 1838. So I guess they had a slight rebound. Because when I was referencing SoFi, I was still thinking of them as the $15 range and their forward PE being like 20. But I guess that's a hard argument to make, right? I guess right now I'd rather go with new. Because if you take a look at their numbers, it's pretty similar to what SoFi is executing. It's beautiful. It's just absolutely beautiful, right? The reason why nobody talks about them or nobody really knows about them is because they don't really operate here in the US. But if you live in Brazil, Colombia, or I don't know, Peru, you would be aware of new. Just like if you live in the US, especially in the Bay Area, Seattle, Milwaukee, Portland, Austin, Texas, you would know about SoFi. Geographic location makes all the difference. It's kind of like you don't get to pick the family that you're born into, right? Some people are born into wealth, a trust fund baby. Like when I went through my MBA program, I was shocked at the disparity of the socioeconomic status of my classmates. Almost every single one of them, their mom and dad, or I guess their family, they came from a lineage of practicing doctors, attorneys, or some of their parents were executives at pretty big companies. And then there was me, a kid that was raised in poverty. And it just, that's like a humbling fact that at the end of the day, we're all human. We don't get to pick the families to be born into. It's just the luck of the draw, the hand that you're dealt. And so you might as well make the most of it. And if you know that you're privileged, and if you know that you're well off, I mean, it just help out, right? Because not everyone has that opportunity, that fair shake at life. Some people, statistically, like they'll have no chance of making a life for themselves except going down a path of crime. So if they're born in a trailer park and mom and dad does drugs, and that's all you see, and you're abused, and they hit you, and you grow up in that kind of hostile environment, do you really think that kid's going to grow up to become a mechanical engineer, getting an internship at NASA? Absolutely not. I mean, it could happen, but statistically, right? That's what I'm advocating here. Statistically, that kid's going to follow suit of their parents. And it just gets to show, like, we got to be nicer to each other, man. It's all just, I don't know. I'm getting into this deep thought right here. I tend to do this when I shower. It's just wild when you think about it. Let me drink some water. And I don't know, even if you think about some of the bigger cities like Detroit or Chicago, even in the same neighborhood or city, depending on where you were raised, you could be destined for success or set up for failure. Like, doesn't that blow your mind a little bit? And that's why when I was a kid, I didn't really understand why so many families wanted to fight to have their child go into the same school district as me. But I think I get it now. Just by going to the wrong school and hanging out with the wrong people, that could really mess you up. And now that I'm a parent, like I have the wisdom and the maturity to realize that. I'm like, dang, man. It's but I guess all that to say, just be nice to people. Right? Some people, you don't know what the heck they're going through, right? They might have been raised with the worst variables and environmental conditions imaginable. Like for a privileged person, maybe the worst thing they ever experienced was not getting the type of car that they wanted at age 15. Whereas for somebody that grew up in a rough environment or atmosphere, possibly their worst day of their life is when their dad got drunk and beat their mom and he got arrested and then there was domestic violence and all this other crazy stuff, right? So it just goes to show, like, even though we all might be dressed and walking around looking alike, the baggage that we carry and the battles that you're fighting in your head, the invisible fight, it just got to be nice to people, man. It's the fact that someone was able to overcome that, to be where they are, to be right next to you or to work with you, knowing that statistically they should be in prison. I mean, you got to give them props where props is due. Just be nice. Just be kind. I think that's the word of the day. This is Sesame Street, right? Be kind. And then there's JD.com. It's basically the Chinese version of UPS or FedEx. They do all of these shipping and their e-commerce. Not really interested. I personally don't really like the idea of investing in Chinese companies. Not because of the history of cooking the books, but because of the geopolitical ramifications. If anything goes wrong, especially with the current administration, with tariffs being thrown around like that, I just don't feel comfortable, right? But under different circumstances, maybe the investing thesis will be different. There's Pershing Square. I think that's Bill Ackman's company. No, I'm pretty sure that's Bill Ackman's company. Am I crazy here? Yeah, they just debuted on the stock market, $37. They're currently 37. You should be break even. I don't know why this is 56. Maybe they IPO'd at 22, but it looks like stock analysis only records it at 37.99. So it's kind of like investing in an asset management company, I suppose, if you're interested in that one. I'm personally not. And then, is there anything else? I think there is another one. I guess I'll do control find, ticker symbol YSS, and that's going to be York Space Systems. You take a look at what's been going on with them past 5 days. Yikes, negative 22% in the red. And I think that's because everyone in the space landscape has been selling off pretty harshly. Let me just verify that. Yeah, everyone in the space has been getting crushed, but it looks like AST, they've been having a slight rebound for the past week. And I think even SpaceX has been experiencing getting their toes stepped on. Yeah, they've been selling off. So everyone in space has been getting demolished. But anyways, it doesn't change the fact York Space Systems, they're crushing the satellite manufacturing game. From my understanding of the landscape, they've built and launched the most satellites for the government, with Lockheed Martin in second place and Northrop Grumman in third place. York Space Systems. So I'm really bullish on them for the long run, right? But the short term, it's looking really scary, right? I mean, you just saw the volatility, but also they're in a downward trend. And the space stocks, all of their valuation, it's bonkers. They're priced for perfection. York Space, they don't have it depicted because they're burning cash right now. But if we pull up AST, do they have it? No. Does SpaceX have it? Yeah, so SpaceX, forward PE being a 55, they're priced for perfection. It's not just unique to Elon Musk. Every single one of them, very high expectations. So it's a rocky road. My gosh, if you bought into them during their IPO and you held on, 66% in the red. And that's why I always say I'm really scared to jump into IPOs, because the inevitable sell-off usually happens within the first year. Case in point, if we pull up Jersey Mike's, they just IPO'd. Let's take a look at what's been happening with them. $23, currently $22.91, pretty much flat. What's another really good example of an IPO that's been going south? Okay, whatever. My brain's not working so well. Got terrible sleep last night as well. So that makes like, what, 8 days in a row, trash sleep. But needless to say, when I think about the space landscape, I think there's a lot of promises and there's a lot of bullish sentiment. But at the same time, I can't help but think that it reminds me of the EV wave that took over all the investors in 2020, 2021. when everyone was overly optimistic with it. But the difference being is that the space stocks, they actually have products that are launched in space right now. Whereas with a lot of the EV stocks that I'm thinking about, like Canoo or Lordstown Motors and some of the other ones, I don't even know if they ever produced a real vehicle on the road besides prototypes. Because if you pull this up and take a look at their P&L, let's see, it's growing at a rate of 52% year over year, and then trailing 12 months, 66% year over year. So the space players, they're actually executing. I'm too scared, right? I'll say it as it is, right? I'm not gonna pretend like I'm man enough to invest into something that's really speculative. I can't do it right now. But anyways, Friday, honestly, I'm looking at this and I'm like, what in the hemoglobin? I don't think I've heard of any of them, which is crazy with the amount of time that I look at stocks and research the markets. The fact that I haven't heard of any of them is, it's because like every single month, there's companies that are IPOing. There's thousands of companies on the market. I think off the top of my head, I could probably talk about maybe 4,500 companies. But these right here, they got to be a part of the other ones that I just don't know about. So I think it's a perfect time for me to talk about this. I have made it my mission for this week to film, edit, and upload another episode of the Public Portfolio series because a lot has happened since the last video. I mean, for crying out loud, as it stands right now, we only have 4 holdings in the portfolio, and I'm pretty much sitting on cash. Now, the Patreon community, they've witnessed all the moves in real time, but I just feel guilty because they know, but you guys don't, right? So I'm finally ready to lay out what happened and the why with the rest of you. And before I head out of here, I just want to say I uploaded a video yesterday. I alluded to it in the beginning of this podcast about what steps I am going to take to get out of this rut I've been in lately. Something I forgot to mention in that video is the lows in life really suck. Like getting rejected, having your business fail, putting in the time, the prep work for this interview or an exam to get into a specific grad school or whatever, and falling short or getting fired, and the list goes on and on, okay? I've been there, done that, I've experienced a lot of crap. But the highs in life, my friend, such as finding a new show to watch, and come to find out there's 10 seasons, or eating at your most favorite restaurant after starving for the past 2 hours, or your favorite stock that's in your portfolio going 25% in the green, dude, sign me up. The highs make life worthwhile. And I wish I would have said that yesterday. I just forgot to say it. The lows are stupid, but at the end of the day, it's a common human experience. I think every single one of us watching this video, we know what it feels like to feel betrayed by someone we care about, to be rejected, or to fail. We all know what it's like. And I don't know about you, but the fact that we have all navigated similar storms in life, I think that's really cool. And if you're young, maybe not, but once you get up there in age, I think most of us have experienced the stuff of like losing someone, such as them passing away, or experienced trauma, experienced setbacks. And that's why I think even though as men, we don't open up or talk about our struggles as much, I feel like we should, because we have more in common than differences. Like we might not have the same or similar hobbies or interests, but at the end of the day, we still share that human experience, right? And I think that's really cool. Anyways, I'm rambling. That's another Compounder's Corner episode. I appreciate you guys for hanging out with me. Truly, I mean that. You could watch anyone else on YouTube, but you choose to spend this time with me. So I love you for that. Stay strong, stay safe, take care of yourself, and I'll talk to you next time. See ya!